We should let Dwight know if he wants to come to South Florida.
Okay, now, Kim, I stopped the recording, so I'm gonna start it again, okay?
Okay.
Here we go. Good afternoon, everybody, and welcome to the Successful Investing 3 conference. This is the 5th class in a series of 5. It's an old-fashioned Let's Talk Stock. We have stock pickers from all over the country, and we're going to give you 16 great, we hope they're great, stock ideas. Let me introduce to you our stock pickers in no particular order. I think it might be alphabetical. We're going to start with Kim Butcher. Kim is presently residing in Southern Florida. Before that, she was from the Evansville, Indiana area. Kim, say hi to everybody.
Hello, all. I hope you're having a good afternoon. And thank God it's Friday.
Our second damsel on the board is a newcomer to our stock panel. She's the president of one of our model clubs in northern Michigan. She lives in Elk Rapids, which is a pretty little town just north of Traverse City. And her name is Charlene Hansen. Charlene, say hello to the group. Don't forget to unmute.
Hello, everybody. It's great to have some nice warm golf weather now, so enjoy it.
We just finished a class with Cy Lynch, a very interesting class on stacking the deck in your favor. And we have Cy Lynch, a raconteur, a lawyer, financial analyst, JAG, and most recently his job is as of a pastor of a church in the Atlanta area. Cy, welcome to Mid-Michigan's COVID cancellation conference.
Thank you, Ken. Welcome, everybody.
We have that Irish gentleman from Pasadena, California with us, and Hugh joins us pretty regularly on a number of our different activities. Hugh McManus is the former president of the Volunteer Advisory Group for Better Investing. He works in the pharmaceutical area, doing all kinds of jobs and jetting all over the world. Hugh, we're so glad to have you with us this evening.
Hey, everyone. It looks like the next conference might actually be the canceled COVID conference.
All right, that would be really good, wouldn't it?
Yeah.
Matt Spielman is a former member of one of the investment clubs that I would belong to, and he was a missed member when he moved to Ireland with his wife and young son because of his job. He's back in the U.S. now. He's retired, and he's living in the Houston area. Matt is no stranger to those of you that are regular visitors to the Manifest Investing
Forum.
Thank you, guys. The Manifest Investing Forum. And Matt, we're so happy to have you with us today as a panelist.
Thank you, Ken. Hi, everyone.
Is Pat here yet, Mark?
Let me do a quick check. I was watching. He is.
All right. Pat Donnelly is with us. Pat is from the Pittsburgh area. Pat is also steeped in Irish lore and pickled a little bit occasionally in Irish whiskey, along with myself. The two of us have that shared I guess is a great word for it. Pat, we are so happy to have you here, and you're on a real hot streak right now with your picks. So we're hoping you're going to help continue that hot streak for us.
Pat needs to unmute.
Pat, you need to unmute yourself. Okay, we're having some sound issues with Pat that we're going to have to get worked on here. And last but not least, I'd like to introduce my great friend, Mark Robertson, from just south of me in Michigan here. Mark and I have been speaking together now for a number of years. He accuses me of hogging the stage all the time, but he has the ability to talk at will about almost anything and be very pleasant about it at the same time. Mark, I couldn't do a lot of the stuff that we're doing right now without your help and support. We really appreciate you in this chapter, and welcome to the panel, Mark.
You're most welcome. Looking forward to having some fun picking some stocks and talking about them.
Let's see if we can get Pat to say hello to us. Pat, can you try your microphone and see if we're getting a hello out of you?
I switched him to organizer, so he might have easier time doing that.
Oh, he might be juggling work responsibilities.
He could be.
Oop, I see something changing.
Oh, he changed to his telephone. So we'll give him a chance to come on his phone while we show some of the things that are happening here. Let's move on. This is the legal stuff. We are going to mention real stocks in real time. We're not suggesting you go out and buy anything. We're not suggesting you sell anything. And if you own any of these stocks, we're not even suggesting that you hold these stocks. We're suggesting that you do the study yourself and you draw your own conclusions about buying and selling and holding. We're going to give you 16 ideas, and the presenter thinks it's a pretty good idea. We're going to be trying to remind you if we own any of the stocks we're talking about. We are recording this for future use, and we'll be posting it on YouTube sometime within the next 24 hours. If you'd like to be reminded about our activities in Mid-Michigan, our free webinars, drop a line to nkavula1@comcast.net. That's my wife's email. She'll add you to our guest list, and we'll be glad to send you a reminder once a month about the free things that we happen to be doing that particular month. We would encourage you to add your sons and daughters and brothers and sisters and mothers and fathers to the list as well. So if they have an interest in investing, have them come and see if we can maybe help solve a problem or two. If you'd like copies of the slides from this presentation, drop a line to Mark R. at manifestinvesting.com, and Mark will see that you get complete copies of all the slides. Pat, how we doing right now?
We're good.
We can hear you. We were worried that we weren't going to be able to hear you. You've been on fire, so we're really looking forward to hearing your picks and why you've chosen them. Pat, again, is from Pittsburgh, and Pat served as the president of the Volunteer Advisory Board, VEEV, for 3 years, and he also currently sits on the NAIC Board of Directors along with Cy Lynch. So we have some really busy people with us right now. So without further ado, let's take a look at what and boy, oh boy, am I getting something coming up strangely here. Let's take a look at our agenda. This is the final class in the conference, a Let's Talk Stock panel, Stock Ideas Now. And we did this about a year ago in May, almost at exactly the same time in May. And here's our picks from a year ago. Notice that Mr. Donnelly holds the lead, and he made a pick that gave us 170% total return in 1 year. That's not a very high bar to have to jump over again.
No,
So we'll see if Pat's going to be able to match his red hot pick. Cy gave us a pretty decent pick. In fact, two of them coming in second place and third place at 128% and 120%. What's amazing is that this collection of stocks had an 87% total return. That means that this collection of stocks beat the market by almost 32 percentage points. Not a single loser in the group, and a few of them didn't do as well as the market, but not a single loser in the group. Here's the stocks that we picked about 6 months ago. They're not doing quite as well as the stocks that we picked a year ago, but we'll give them another 6 months and see how they do. But again, notice that Mr. Donnelly is up there at the top of the list with only a a 60% total return. So Pat, you've really set yourself up for people listening to what you have to say. So we've put you in the middle to keep the interest moving towards your presentation, and we'll see how that works out. We're going to start by listening to Mr. Cy Lynch, and Cy's first pick is MKS Instruments. Cy, just tell me when you want me to change slides, and I will.
All right. Thank you, Mark. Ken.
You're welcome.
And
we frequently are confused for each other. So.
Yes, y'all look alike. I can't tell you apart. Actually, but yes, thank you, Ken. And actually, both of my picks today are a little bit odes, perhaps to Pat's last pick, which was a semiconductor stock. My second pick is a semiconductor supplier pretty much exclusively, and we'll get to that one next round. But MKS Instruments is also a semiconductor supplier. But to start off, let's see where I came up with the idea. Next slide. Here's the graphic for its historical sales and earnings. Notice, which is not unusual for an industrial company, and particularly a semiconductor-related company. There is some cyclicality to it, particularly in profitability that you can see, but the sales growth is generally up and consistent. And while there's volatility in the earnings, it too is heading in the right direction. Next slide. I came up with it by just doing a screen on the manifest database. I was looking for very high quality company, 90th percentile and above, very financially strong, 90th percentile and above. And usually as I do, I round down a little bit from the sweet spot par value. You see here, it was 11.5%. And I rounded that down a little bit to 11. And here are the companies that came up. And I am familiar with MKS Instruments, having presented it a couple of years ago with Roundtable, and someone else presented it even before I did with Roundtable. And so that's where I picked it. But before making it my final pick, I usually do an industry comparison. So next slide. Here are the scientific and technical instrument companies ranked by growth. You see MKS is the highest growth. I was really looking for growth in this particular pick. And so it came in first. And notice that it's one of only two companies in the industry, 2.6 being the other one, that have par values in the green zone, that being at least 5 and not more than 10% above the average market return. Next slide. I also like to rank by quality to make sure that I'm buying among the best of the best. And you can see that MKS comes in right in the middle of that nice blue quality. And really, there's no great difference between a 95 percentile and a 98 percentile. And as you see, it is the one high quality stock that is selling in the green zone. So let's look at MKS Instruments. Here's roughly the value line description of the company. They started out again in semiconductor related industry, which is where value line talks about their instruments and other components to measure, control, and analyze items in that manufacturing process. The reality is that's their business. Instruments, components, measurements, and so forth in the industrial manufacturing process, starting with semiconductors, but they've now gone into areas that in some of the company slides you'll see called advanced areas, and that's fiber optics, flat panel displays, lasers, solar cells, and the like. And then you could see at the bottom of the slide some of the specific instruments that they make. Next slide. They've been around for 50 years. we don't have that full 50-year history in front of us, but this isn't a brand new company by any stretch of the imagination. Here's just from a company slide, the summary of their revenue growth and earnings per share growth not calculated by GAAP, which takes out a little bit of the volatility. You could see has been very strong over the last 5 years. Next slide. Here's their growth story. They start with transforming the business from the semiconductor market into, like I said, what they call the advanced markets. And they believe that they execute on their financial promises, creating value through cash flow that allows them to make strategic acquisitions and other things that enhance both the business and the shareholder value. Next slide. This is just a quick picture of about a 60-40 split of their revenues in 2020 between the semiconductor core market and then some of their more what they call advanced markets, getting into other industrial processes, even into the life and health sciences, the medical arena, as well as research and even defense related areas. Next slide.
I'm sorry, Si.
Ken's giving us the up close and personal view.
There we go.
Here's you saw a little bit of this graphically. This is a numerical chart showing you some of what you've seen on the last couple of slides, particularly the revenue growth. See how the semiconductor market has grown at about 20% a year over the last 5 years. Their advanced markets expansion's grown at 30%. Notice that their market categories, that being their areas where the company ranks either 1 or 2 in their market area, has increased from 7 to 15. They've nearly doubled their patents and drastically increased earnings per share. And of course, you can see down at the bottom, have tripled the stock price in that time. Next slide. I briefly mentioned this in one of their summary slides about their growth strategy, but one thing that management stresses in their presentations is their cash generation. And here is a graphical depiction of their cash generation since the year 2001, so basically this millennium, and how it's been steady and up. And they even down at the bottom say that last year's trough, the bottom of 2019, is well above even the highs of earlier years in 5-year chunks. Next slide. They use that cash primarily to acquire businesses to expand their expertise into related areas. And I think there's a slide that briefly mentions their strategy. And then you also see their R&D. They make acquisitions using debt and then pay off debt, pay dividends and share buybacks. But more than half of their cash flow is used for acquisition. That's a major part of their strategy. Next slide. I guess I excluded that slide, but the company does tell you that. And if you go to their website and look at the full report, you can see it. Here's how they plan to increase earnings by 18% over the next 5 years. In the semiconductor market, they're looking to do the market for wafer fabrication equipment, semiconductor equipment, beat that by 2 percentage points or 200 basis points, which they have done historically even better than that. In their advanced markets, their measurement is gross domestic product, and this is nominal gross domestic product. That is not inflation adjusted, which actually tends to run 4 to 5 percentage points a year on average, maybe a little bit higher over the next 5 years, depending. They expect to beat that or are targeting 3 percentage points. So that gives you some idea for their both sales and earnings projections. Next slide. And these are my judgments for the company. 12% growth rate, right in line with their historical rate. I had a pre-tax profit of 20, 18% tax rate, which is the company's projection, with a high PE of 27, leads to a 350 high price. Next slide. And that leads me to, with a little bit of a yield, to 16.7% potential return. That compares with Manifest's average return of 12.8, which is a little below my high PE-based return and a little bit above my average PE-based return. In fact, just about right smack dab in the middle. So I'm encouraged that the Manifest consensus are in line with my projections. And I do not own MKSI, but maybe after this presentation, I will.
Thanks so much, Cy. We're going to go to Hugh now, and Hugh's choice is Gossamer Bio.
Hey, everyone. So, as usual, I'm picking biotech, and I know what I do seems crazy, but part of the reason for this was driven by the fact that years and years ago, before most people here were born, when I was a student, I didn't have any money. And so to buy proper companies, back then it was things like Upjohn and Intel and McDonald's and the work, I needed to get cash. And I had noticed that when an event happens with a biotech company, either an FDA approval, results from the clinical trial, fundraising, spectacular news from R&D, when one of these things happen, the stock price could respond amazingly. It could shoot up dramatically. Of course, it can crash as well. But the point is that because the clinical trial process is very well organized and orchestrated, you can almost time when these events are likely to happen. Chances are, as I said before, it's very high risk because there can be bad news, horrendous failures, as I described there. And I always jokingly say the good news is that once the share price hits zero, it stops, it doesn't go any further. But the sky's the limit, and there are many examples of that. And although what I do seems reckless, I do it to generate money so that I can buy real companies, real boring companies that just trudge along year after year and will make me happy, I hope, when the day comes that I retire. So what I do is look at companies near a 52-week low and dig into them a little bit to see why. And on the next slide, I decided I would just show you all of the companies that I found earlier this week that were near a 52-week low. These are biotech companies, and I have ways of eliminating some of them, but there are lots of them. There are always lots of them. There are hundreds of biotechs, and right now a lot of these biotech companies are on the ropes. At least some of them are on the ropes. They've got bad news. You can see this huge, long list. I eliminate companies that don't, if we skip to the next slide, I eliminate companies that carry an awful lot of debt, that don't have a lot of cash in their books, that maybe the stock price might be very low, that do not have a good pipeline, that don't have very quality people in the company. And nowadays, it's very easy to identify them thanks to tools like LinkedIn. So I do look for a good cash position. I eliminate cheap stocks, but that in itself can be risky because there are many examples of biotech companies that turn around. I do like novel technology in the clinic. I like a consistent story where clinical trials are going well. And just a heads up, if the phase 2B, what they call the pivotal clinical result, is good, that's a good sign. The phase 3 trial, which is the one that counts when it comes to FDA approval, is sometimes as good as the phase 2, but not always. But it's almost never better. But the phase 2B trial, the pivotal clinical trial, is a real hint as to whether or not the company has a drug. They have a partnership with a major pharmaceutical company, that's good too. And currently, I didn't put it in this list, but I look at a site called Crunchbase, CRUNCHBASE.com. It's mentioned later. And I look to see who invested in this company early on, because they do due diligence, not only on the technology, but on the people in the company as well. So yeah, I talk about the venture funding and who put money in that company. And you get used to reading some of these venture companies, the high caliber ones that often know what they're doing, but it's never 100% perfect. because I'm in the pharma industry, I can link to people and they accept my linkage on LinkedIn. And if a lot of people are suddenly leaving the company, well, that's a clear warning sign. But of course, if the company is hiring and people are joining, well, that's generally a positive sign. So there are a lot of tools nowadays that you can get a background check of what's going on with the company. Can we skip to the next slide? I picked Gossamer Bio. Now the share price was below $10, which you know is kind of risky, but it is near its 52-week bottom. Now this is not, and I repeat, not an NEIC/better investing/manifest company because it has no earnings, and in fact it's only been public for 2 years. And part of the driver here, quite frankly, is I need to beat people like Ken and Mark in this competition. So it does engender in me a certain middle-aged recklessness that's probably more appropriate for a teenager when it comes to picking these companies. It's based in San Diego, and it focuses on immunology, inflammation, and oncology, 3 great areas. If we skip to the next slide, you can see the company was founded in very recently. It has about 100 employees nowadays. It has raised almost $500 million. Arch, Midcap, these are 2 of the very high-end VC funds. It currently has about $453 million in cash because it did an IPO where it raised over $250 million, but it's burning about $40 million a quarter, a lot of money. It will need to go raise money next year or the year after, but it did some debt financing as well. Debt is really cheap nowadays, and some companies elect to do that. Wait for good news, raise money, and transfer that debt into capital again. Sorry, into cash. And you can see websites, Gossamer Bio and Crunchbase, which is well worth looking at as well. It has 4 clinical programs. We skip to the next one. I think there's a slide that shows its clinical pipeline. GB, Gossamer Bio, that's the code name that it chooses for its companies, but for its drugs. But the lead is in phase 2. It's GB002. GB001, which is second from the bottom, had bad news recently. I'll refer to that in a second, but it actually has 4 programs, and for a 100-person company, that's pretty good. Most things fail in the clinic, but the more you have, the better chance you have that something will become a drug. Skip to the next slide. I know I have very little time. The lead program right now is GB002, which the company Pulmokine bought it from Gilead, and Gossamer spent $5.5 million to get it from Pulmokine. So they're now moving that drug forward. It has orphan drug status with the FDA, and it recently started enrollment in its phase 2 clinical trial for arterial hypertension. It's also being looked at in ulcerative colitis as well. So let's hope at least one of these indications pans out. The next 2, GB004 and 1275, they're a bit earlier. They're looking at inflammatory bowel disease, IBD, which is pretty hot right now and has been for a while, but it also has an important asset in oncology for solid tumors, which is enrolling in a phase 1 trial. That's the trial where you generally look at safety, but generally for oncology or cancer drugs, there is often an element of efficacy in these trials as well. And if I skip on, I think I mentioned GB001. Well, I do tangentially. As I said, warning again, it's not close to a better investing type company, but I am driven to beat my dear, close, darling friends in this competition. Okay. It has bad news. And by the way, you do have to learn to get calluses with bad news with these types of companies and try to read through it, because a 52-week low doesn't happen with good news. It's only bad news. It did have bad news with its GB001 drug. It did not beat the placebo in the clinic. And it had a 2-for-1 punch there, because about 12 months ago, maybe or close to that, another DB2, that's the enzyme in the body that the drug inhibits. Novartis was targeting the same enzyme, and they discontinued their drug because it failed in the clinic. They called it discontinued, but it failed. And it got hammered in December of 2019, the shares of Gossamer, because they had a similar asset doing a similar thing, and investors wisely decided that if this mechanism of action doesn't inhibit the disease, that they're likely to have bad clinical results too. And indeed they did. But they're still going ahead because in the clinical trials, they were able to ferret out some nuggets of good news, and they are at least hoping to salvage this asset. But they're not talking about it a lot right now, and that's usually a sign that the program may be discontinued in the future. We'll see. So skipping along, the outlook, well, it's a very high-risk company, but it has reached some kind of an inflection point, a 52-week low. It has been at this little bounce around there all week, so it doesn't look like it's going to go lower. It's pivoting to a brand new lead drug. It's spending a lot of cash every year, and it will need to raise money soon, by the end of next year, by mid to the end of next year. But it is a sort of company I love. It is high risk, so it's either going to go to zero or it will go up 4 or 5-fold. There seems to be very little middle ground with these except for Ardelyx, but I'm sure we'll hear about that at some point soon too. So that is the pick, GOSS, Gossamer Bio.
Thank you so much, Hugh, and I wish you luck. Not a lot of luck, Hugh, but I wish you some luck, okay?
Very kind, I do need it.
You're welcome. Our next presenter is Charlene Hansen, and Charlene's going to talk to us about Malibu Boats. Charlene?
Thank you. Well, we moved to Elk Rapids, which is a community on Grand Traverse Bay of Lake Michigan 18 years ago. And the first thing we did was buy a boat. We've had power boats and a sailboat in the Edward Grace Memorial Harbor. And even though we no longer own a boat, I still serve on the Elk Rapids Harbor Commission because of my interest in the access to our beautiful water resources. So while looking for a small company for our portfolio, Malibu Boats just kind of grabbed my interest. The sector is consumer cyclical, and the industry is recreational vehicles. 2 California guys started building boats in their garage in 1982, and it grew into one of the top 3 boat companies in America. By 2014, after building the Cobalt brand and acquiring Axis Boat Company, they went public. The expansion continued in 2015 by building boat trailers, and 2018 by acquiring Pursuit, which is that large boat on the top left-hand corner, which is a larger boat line. Then during 2020, a new larger manufacturing plant was completed, and last December, the acquisition of Maverick Boats took place, which is evidence of their expansion plans. The boats you're looking at represent Malibu, Cobalt, Axis, and of course the Pursuit line. Malibu is a leader in performance boats and have maintained the #1 market share in the United States since 2010. So picture wakeboarding, wake surfing, and water skiing, as well as leisure boating. These 4 boats, as I mentioned before, represent their main brands. Each category has several models and healthy price tags to go with them. There are special features that make these boats unique and desirable in the wake and surfboarding and water skiing communities. They're called the Wake Hull, the Power Wedge, and the Surf Gate, and a flip down swim step. And those are all company inventions. These enhancements heighten the experience and the challenges during water sports and competition. Malibu brings out 3 to 4 new boats every year, as well as new features, and that are continuing to grow their market share. They are known for their creative innovation that allows computerized driver controls, making them the leader in performance boats. Next slide, please. Directly ahead of the steering wheel, a 12-inch touchscreen gives finger tap control of the ballast, power wedge, surf gate, and navigation. It has computerized rider presets and controls a variety of gauge displays. Technology is riding the waves. Next slide, please. Based in Loudon, Tennessee, it operates through a network of independent dealers in Europe, Asia, the Middle East, South America, South Africa, Australia, and New Zealand. Sales for the last 5 years have increased 32%, and earnings per share have increased 30%. An increased appetite for outdoor activity following COVID is expected to continue that growth. You can see my sales projection is in line with the trend line and the CFRA estimates I plugged in, which are represented by the forward dots on the graph. And if you see that green line that kind of goes straight up off the chart almost, that refers to, if you look at the analyst consensus estimates, the sales increase of 3,888 is some kind of an, probably an error in the data, and Better Investing is looking for the culprit to see what caused that. But so I'm just have ignored that and gone with the analyst projections. My earnings forecast came from using the Better Investing preferred method, which required little adjustment on my part. The graph shows up, straight, and parallel since going public in 2014. In the Evaluate Management section, the return on equity outliers for 2016 and 2017 were removed, and that's over under 2016 and 17. Those anomalies are attributed to, big words here, recapitalization, IPO, and equity transactions after going public. The annual reports for those years provide interesting reading about the stock buybacks from the former LLC shareholders and from the initial IPO. It's a little too in-depth to wade into today, but looking at the following 3 years return on equity, it has smoothed out with nice high returns, well over 20%. Debt has been reduced consistently the last 5 years until December of 2020, when the acquisition of Maverick Boat Group was made for a purchase price of $150.7 million. They still have great cash flow with cash on hand of $40 million and approximately $110 million available for borrowing, leaving them well positioned to pursue more strategic investment opportunities and continue to look for appropriate acquisitions. Vertical integration is a strategy Cobalt uses to manage its supply chain, inventory, and quality. This allows them to reduce costs and increase efficiencies. If interested in this company, visit the investor section of their website for a very informative video on this process. Next slide, please. 5-year high and low earnings per share outliers were removed to find reasonable numbers for the high and low price projections. I chose the 20 PE forecast to determine the high price, as its high PE has been consistently near that range or higher. The high price projection is at $199. The low price I forecast is $45, which is almost half the current price of $85. Morningstar gives Malibu a fair value price in the range of $90. Next slide. The upside down ratio is 3-to-1, showing the compound annual return is in the range of 16 to 19%. Also impressive is that Malibu has beat analyst estimates 5 times over the last 5 quarters, with the last quarter just reported having record highs in sales and earnings. The next slide, please. Manifest investing quality is 96, and their PAR is 15.1, which is very close to how the compound annual return showed up on the previous page. And it puts it in the sweet spot of my PAR. Competitors in the industry I compared Malibu to are Fox Factory Holdings and Patrick Industries, both good companies, but Malibu was better. I didn't use Chaparral or Sea Ray because the companies owning them are low quality and PAR in manifest investing, and all of those companies are involved in a variety of businesses. I like Malibu because building boats is their business, their only business and main focus. If you're interested in running out to purchase one of these beautiful boats, take your banker. They retail between $125,000 to well over $200,000. Me, I just own some shares, and that's a wrap.
Thank you so much, Charlene. Really nice job. Thank you, Charlene.
Thank you.
Our next presenter is Kim Butcher. Kim has served on the Volunteer Advisory Board at various times throughout her volunteer career. She was on the Chapter Governance Board down in Evansville, Indiana, and today she's serving as a caregiver for her mom down in southern Florida. Kim's stock is Palantir. Kim, it's all yours.
Okay. As many of you know, Mark talks a lot about Kathy Woods and ARC, and always talking about how Palantir is, she's buying the stock. So I decided to do some looking. And the first gentleman on the left is Peter Thiel, and he's founded this, and he wrote a book, 0 to 1. I highly suggest it, and if you look for 0 to 1 and PDF, you can probably find a copy of it. But it talks about how to go from a startup to a business. Well, he's also the one who started up PayPal, and that did quite well. So I thought, if Peter Thiel was involved in Palantir, I thought I'd go look it up. Well, the guy who is the CEO now is Alex Karp, and they started this in 2003. And Alex Karp was also one who helped develop with PayPal. So since I know personally I have PayPal and I know that's done well for me, I thought, I really need to look into this. So you can see where the name was derived from the Lord of the Rings, where they were seeing stones as indestructible balls of crystal used for communication to see events in other parts of the world. Well, this company is very interesting when I started doing my research, because everything now is data. And how are they going to analyze it? Well, every time I go out and I get anything, they want my phone number. So then they're tracking, I'm sure, what we're buying, what we're doing, and where we're going. So this company has two areas. They have Foundry and they have Apollo for Edge AI, artificial intelligence. Now, believe it or not, Foundry is who the government partnered up with, where every dose of the vaccine that is ordered, allocated, tracked, and delivered is what this company is following. They've also announced that they're going to have free training to veterans and shareholders on how to use this system, so that how can make anything simpler, because this company takes all the data and they have proven methodology to prove how you can get better outcomes, cost reduction, and that's what this company does, which I have no clue on how to do any of that. But they have battle-tested architecture, which proves a service, compared to where a company would say, oh, we can provide this for you, and then they have to go out and develop it. And then you cross your fingers it works. But they've done it. So next slide. This is from their quarterly report, which turns out was earlier this week. I didn't even have a clue that that was going to happen. The revenue growth year over year was 49%. Their adjusted income was 117 million. And if you'll notice that there in the first quarter of 2020, that was negative. Now we're to positive. So they've increased their margin to 34%. Now, I'm always about cash flow, not necessarily about earnings personally. So they really went from a negative to a positive. So they increased their free cash flow margin 44%, because they're starting to bring in lots and lots of business in the private sector, because they started off first with the government, and they have many contracts with our Defense Department and a lot of different defense departments overall. So when you listen to them on YouTube, and there's a lot of videos out there that I watched, they specifically say they want the West, meaning the United States, to have the greatest infrastructure, so we are the strongest out there. And I kind of love it that they want our country to be successful in all of this. Next slide. Their government growth in the last quarter rose 76%. Now that's huge. year over year, and that was 83% of that growth is from the U.S. government customers. And so what's also happening is those customers with the government are repeating business, and the repeating business is higher and higher. Now, they started off with the government. Now they're going into the commercial area, and that generated 133 million, which was up 19% year over year, which was an increase of 72%. But the thing that's really interesting here is they only have a handful of Fortune 500 companies, which is 0.1% of that spending is of the Defense Department. So they only have a handful of Fortune 500 companies and only 0.1% of the Defense Department. That is a huge amount of growth area that can keep on going. Now, to have a catalyst into the commercial business, they've hired 50 more sales people for a direct sales force to be able to integrate into these businesses to find out how they can have the best supply chain, how they can have the best, safest area, because they've got new contracts for Chrysler, they've got new contracts for MD Anderson, they've got it also for Airbus. This company is having people come to them saying, please, can you work with us to make us more efficient, because that makes us more profitable. And the interesting thing is the goal for revenue that they have stated they want to have by 2025 is $4 billion. And all these contracts they have are on average for 3.7 years. So they're getting more contracts, they're getting the same customers to extend the contracts and have more business. And next slide. I always like to look at what are the insiders doing and how are they making money. So I like to go to the 14A filings and I like to see how it does. Well, this company wants to have the stock-based compensation is their largest expense they have, because they want to have the best people. They want them to work hard. They work hard, that's going to get the company to move forward. So they give stock to their employees and yes, to their management, but it is also to the employees because they want to attract the best ones. This company, when you think about it, is not capital intensive. It's capital light, because what they're spending their money on is what? The people and the computers. And they've got the best analysts who can write all those funky programs to make everything much more efficient and much more profitable. So on average, from what I've read and what I understand, the biggest expense that this company has, which is on the balance sheet, is the expense for stock-based compensation. So if you add it up, they probably, the last quarter, which was they reported out this week, they had a positive free cash flow after they took out all their expenses. Their expenses will probably be 100 million a quarter, approximately 75 to 100 million a quarter for those shares by insiders and employees. And the other thing is you need to know that there's 2 large option grants that will expire at the end of December for Alex, who is the CEO. Now, this is the thing that I have to say. I don't care if stocks are getting necessarily sold. I like it when stocks and the insiders are buying shares. Why? Because that means they have great feeling that they'll have success in the company. I've read those Form 3s and those Form 4s that insiders are selling for divorce, for family issues, college. You know, people need money too, and most of these insiders, they have to use what they call I think it's a 10B-1 selling plan. So they have to decide on what their selling plan is, and it has to be done in their IRA. And it has to be done, that plan has to be set out already. It doesn't, oh, the stock price goes up, I'm going to sell it. They may sell some shares every single quarter. so they can just capture their profit. And that's kind of like what some of us have to do is when we see a stock that has run up, we think it's overvalued, what do? We sell some. But these being insiders, they have a plan. They have to go by the plan. Next slide. Looking ahead, they plan on having revenue growth of 43% or 360 million. Operating margin is 23%. And for the full year, they want to have free cash flow generation in excess of 150 million. But long term, they want to have revenue growth of 30% this year and consistently for the next 4 years. Now, I could have tried something to do an SSG for you guys, but everything shows up no meaningful data. Why? They have negative earnings. I'm looking at they had positive free cash flow, and just this week when they reported it, they had the positive cash flow. Now, one of the things that Mark has been talking about in the lectures is that, what about Bitcoin? What's going on? This company is so forward thinking, they may start, they do accept Bitcoin, and we may start seeing it on their balance sheet. So that's something that you might want to be aware about if you want to have a stock within your bailiwick that does Bitcoin. Now, they had a pullback in the stock price at the end of the quarter, and ultimately what happened is, Mark's always talking about, next slide, Ken. He likes to have a stock when it gets down to an RSI 30, 20. Well, this was done, this slide was like Wednesday night, and the stock price had gotten down to like $17.50. Well, I looked it up and it's like 20 bucks. So the RSI was nice and low, and it's starting to bounce back up. So I would say that I hope you will consider Palantir, because this company, I believe, is going to be the infrastructure of businesses to make them more efficient. And if they're more efficient, they're going to have better cost structures, better supply chain, and everything going forward. And this might be a company that will be everywhere, kind of like how a Microsoft was everywhere. That's how I'm interpreting this. So I hope you guys would consider this stock in your portfolios. And if not, that's okay. I will admit I do have some shares in my portfolio. Thank you.
Thank you, Kim. Our next presenter comes to us from Houston, Texas. Matt Spielman's going to present Green Brick Partners. Matt?
Great, thanks, Ken. So Green Brick Partners is a home builder. It is a stock that I own. It's a small company by just about any way you'd measure it. It had just under $1 billion in sales in 2020. It has a market cap as of earlier today of about 1.1 billion, and its sales growth is not only well over 12%, it's actually over 25% annually. It was founded in 2008 by Greenlight Capital, David Einhorn's organization, along with Jim Brickman, who is a veteran of a number of real estate areas, including commercial development, but also residential development. Obviously, this is in the wake of the 2008 financial crisis, where a number of private equity organizations were looking into sort of the aftermath of real estate and investing in a number of ways. Green Brick came public in October 2014 through what's called a reverse acquisition. So they found an operating company, and in fact, it's somewhat similar to how a SPAC works today, although both of them have existed for a long time. They found a company called Biofuel Energy Corporation, which is based in Denver, Colorado, and essentially bought them out for the asset that is their public NASDAQ listing. So a relatively small amount, but in legal action, it's actually that Biofuel Energy Corporation that bought Green Brick Partners, and then became that same legal entity. So we'll come back to that it's a complicated beginning. We'll come back to that later on. But first, I did want to touch on the fact that I would be bringing a real estate company at a time where certainly there's a lot of headlines going along this way. There's a frenzy not only for home building but home buying. And why in the world would we be looking at a cyclical company at what feels like it might be a cyclical high? So next slide, Ken. This is a slide from the Federal Reserve Economic Database, or FRED. This is monthly data that represents the seasonal and adjusted analyzed rate of new home starts in thousands of units. And this data goes from 1958 up till 2021, February 2021. And so I've left this, very much zoomed out, but something to look at. If you draw in your mind what might be an average for this time, you can see just, of course, over time how cyclical this data has been, this activity has been. Certainly, you can see the last peak in 2006 of home building activity. But after that point, you can see from the trough in 2008 until present, what is the deepest and widest decline in home building activity in this entire 60-year history. And the fact that although certainly there are supply issues in this industry, and there's a lot of, again, froth in what's going on, including spikes in land prices, spikes in lumber prices, we're actually only approximately back at the mean. We've only reverted the mean from that deep trough. We're quite far. We're actually 30% below what would be the 2006 peak. So I would contend that while this will be a cyclical industry at some point, there's some room to run to go on here. Next slide. One point in the last slide, we don't have to go back to it. Keep in mind that number is actually a raw number. It's not adjusted. It's not per capita or adjusted for population. So over the time, over the term of that chart, the U.S. has 75% more people today than it did back in 1958. And while the data doesn't go back quite that far, the U.S. has 22% more households, which of course all need someplace to live, than since the year 2000. But all real estate is local, and so while the U.S. has had declining population growth over time, that certainly does depend on region. So that's where this slide comes in place. Overall, from the decade of 2010 to 2020, the U.S. overall grew 7.3%. That's not annualized, that's total growth over the decade. The list on the left-hand side shows basically the top 12 and bottom 12 states in terms of growth, with Illinois being the only state to actually lose population over that time. But you can see sort of the top states to go through, and those aren't surprising if you follow home building or any kind of migration trends. It's not surprising that the states that show up in terms of either group, really. But the point here is that Green Brick operates entirely in states that are high growth in the U.S., but also has a number of other states which could be future target and fuel future growth. Now, of course, you can build homes for more than just population growth, but that's a great tailwind for any company looking to be in this industry. Next slide. So to click down even more to look at where Green Brick operates. So you can guess from the chart that they are based in Dallas-Fort Worth. That's where they started. They've had a number of operations added to there. Atlanta is their second largest market, along with the Florida Atlantic coast and Colorado Springs. So one of the things I want to call to your attention is the column on the right, the ownership column. It's not unusual in the home building industry to acquire companies. You're looking to move in a new market, you may look to buy someone out and readily get established with land, with actual employees, builders to work with, that sort of thing. But remember, this is Greenlight Capital is a significant investor in here and founding group. So what Greenlight strives to do that's different than others, and this will sound a little grand, is they want to be somewhat like Berkshire Hathaway's approach, where they have a very light central office really are only interested or only dictating sort of the financial results, but also providing capital. And they want to be the acquirer of choice. So they're quite comfortable getting into a position with a outstanding local builder and not demanding an immediate buyout or some kind of quick exit. They're happy to work alongside with them for a number of years and make sure that they are comfortable at some point where they are looking to exit the business they've built and know that someone is looking after their baby, that they're not just slapping the Green Brick name on top of it and it's as if the old company never existed. They want to build on those local brands. And so even from the standpoint, if you look at Challenger Homes, the last one, it's footnoted in pretty small print. It says equity interest. They actually are a minority investor in there. It's 49.9%. But even a number of the 100% ownership outfits in Dallas didn't start that way. They're happy to start in partnership with a strong builder to make use of their knowledge of the local area. I mean, not just knowing landowners, knowing contractors, but also knowing the permit office, knowing local government, and they will build up their equity ownership as the owner, if you will, the outgoing owner or partner is comfortable sort of handing over the reins. So that's a bit of a different approach to what otherwise on the surface looks like a regular approach. Next slide. So we are kind of at a peak of activity. There are two really limiting factors that come in. The first one is land. If you're looking at a home builder, one of the first things you should look at is the land pipeline or amount of land in development. Just for reference, Green Brick built last year 2,208 homes in 2020, and currently has 2,303 homes under construction. So you can see they have many years of land available, even at a high rate of growth. The other thing to bring to your attention is the significant growth. What is the gray, the bottom part of the bar instead of the green top part? They are moving more and more into controlled lots, so they have options on the lots as opposed to buying it out. You can see that's a significant percentage versus their early years. And in fact, even given now, the bars except the right one are end of year. The right-hand one is just end of quarter. But if you look at the two of those, they're actually starting to consume their own lots and look at more of their backlog being controlled. This also is common for larger home builders. But again, with private equity behind them, they're not at all afraid of pricing out and investing in options to make sure they've secured land. The other thing, I don't have a slide for it, there's a lot of headlines in terms of the price of lumber. And there are two items that the company is using to control that cost. First is that they are not selling a house until they've begun framing. So in essence, not only have they priced the lumber because that's volatile, but they've also secured it. So as not to extend the weight of a buyer for building because of supply chain issues. So everything's on hand, and then they begin, but they begin soon enough that they can still pick fixtures and colors and things like that. The other indicator, or what they're able to do, is they're actually able to pass on the cost increases of lumber to the customers. You can see that because their gross margin is actually increased during this time. So last year, between first and fourth quarter of 2020, their gross margin increased 2%. And from Q4 2020 to Q1 2021, it was actually another 0.3%. So they're maintaining gross margin. They're not having that compressed. And of course, that's because the existing home market is also tight. So people can't get fed up with the cost increases of new homes and turn around and buy an existing home. That's not available as well. All right, let's go to the SSG. Next slide, please. So this is the SSG, and you can see pretty astounding rates of historical growth in all three. And what might be a good company in there, but certainly the initial years are kind of all over the place. I called your attention back in the first slide. The company actually did a reverse merger with an operating company, and they did that in fourth quarter of 2014. So although this data is true in the fact that this legal entity did have business in there, this is actually the prior business that's in there. The results were not restated to be results of Green Brick. They were the biofuel energy. So let's go to the next slide. So we're gonna disregard those first 4 data points and get a very nice up, straight, and parallel view. You can see still very solid growth, 27.7% sales growth, pre-tax profit right in line with that. One blip in earnings per share, right? So that was a tax event in 2017, but right back up in line. Very good pre-tax profit on sales is up, return on equity is up, and then debt to capital is even. This is something that they take pride in, the fact that the company is growing quite well and not doing it by over leveraging. If you look at the quarterly earnings report, and actually this is actually a good aspect of all of the home builders, they very much watch each other and communicate to their shareholders comparable numbers across a broad array of companies. And for a smaller company growing more aggressively, this is actually very well managed. Okay, let's go to the back. Next slide. Just going to cover section 3 and point out, and I've taken out a couple high points and then the low point from last year, but I'll say with the PEs I've struck out, both the average high and low have lowered. But given that this is a cyclical industry, even though it's a high grower, it's essentially being rewarded with industry average PE. So the average PE is 9.3. Yesterday it was 9.5. 9 to 10 is what you'll see basically all across the home builder industry. So that's, on one hand, it's easy to expect that. On the other hand, you wish it would be rewarded a little bit more that you'd be used to with a high grower like this. Now I'm going to switch from the SSG looking at valuation and go to manifest. Okay, so looking on May 6th, which was the date of the Q1 earnings, you see a company that's unrecognizable. And I'll say I first bought this company in October, and so I've had this clunker sitting around with a full portfolio position in my personal dashboard for about 6 months, pulling down all my portfolio averages. But clearly, looking at the sales growth, looking at the profit margin, this is also impacted by that prior data. And you may think, well, that was a lot different than the growth rate the first SSG showed. I would tell you, if you were looking at this company in the middle of last year, when you had 2010 to 2019 data, instead of 2011 to 2020, you would also come out with 5% sales growth and similar numbers. So rather than needing to spend another 20 minutes transforming this, we can just say, next slide, please. Our chrysalis has turned into a beautiful butterfly as of the data update this Monday, thankfully. And you can see now this is a company just like that second SSG that would be a good addition to any portfolio. High quality, 94, great par in the sweet spot, but really above that. And now if you look at the boxes on the right, not only in the top in residential construction section, but also top in discretionary, top in its sector. So you imagine that having looked at this company for a while, followed it, suddenly it will start showing up on screens. Suddenly it will start becoming discovered. But even this company is actually somewhat pessimistic. Give me one more click, Ken. If you recall, the sales growth we had seen historically is 27.7%, and the average PE was 9.3. So what this eagle is really telling us is that if we almost have your sales growth and we almost have your average PE, we're going to knock your par down to 15%. Now, before you internally just multiply par by 4, let me give you a couple things to watch out for. I do think the net profit margin there is high. Right now, it's north of 15%, and it will improve. There are a lot of comparison companies in home builders that you can look for references on what it might improve to. I would also caution you when you're thinking about that is these companies operating fully in the US would be greatly impacted by changes in the corporate tax rate. So think about what the corporate tax rate might be and be conservative there. Also, the projected shares outstanding. This is a company that's growing and growing by acquisition. They are not afraid to issue some shares. That's one of the reasons how they keep their leverage down. So while I don't think that they will double the shares outstanding, I also don't expect that the shares will stay even over the next 5 years. So I do think it's a great opportunity. That's the end of my numbers. I want to leave you with one more point of what Phil Fisher would call scuttlebutt. Next slide. Last slide. This is an answer to a question from Jim Brickman in the earnings call last week. As a small company, always growing. You're always facing questions of what's next. Their last acquisition was the operations in Florida in 2018, so that's been around for about a year. And Jim let the cat out of the bag that they are looking at Denver. Denver is next. This is not disclosed in the 10Q. This is not disclosed in the earnings release. It's obviously as they're looking around, I'm sure the Denver Business Journal will be picking it up. They will have a investor call or an investor day, which last year had been around June, will be in August this year. So it'll probably become more widely known. And of course there's still a lot to know about this. What's the size? What's the method? But they already have disclosed what the new target is, and so I would just view this as they have a good region to keep growing in. That's Green Brick Partners.
Thanks, Matt. Here we come to Pat. Pat, we're waiting to hear about Algonquin Power and Utilities.
Oh, thank you. Man, these are some great companies so far. So I'm going to take it easy and so I don't pull a hamstring after all those other picks I had. So, so yeah, we can skip through this. This was left over from a presentation I did the other night. But so it's always good to hear the why, sort of copying after Cy. You know, why did I come up with this company? Well, I was taking a look at my portfolio and there was something missing. If you click the mouse, I think we'll see, hey, I'm missing utilities. So seems like a good time to take a look around at utilities. We'll take another next slide. I am going to go kind of fast, so slow me down if I need to. Taking a page out of U's world, I have a filter that I run, a screen, whatever the correct term is. And I'm always looking for quality companies that are paying dividends typically and are in their lower portion of their price ranges. So that's where Algonquin came in. You see the projected yield there. So I like a growth company and I'm liking yields. So it's paying a dividend. Hasn't scared me away yet. So I decided to take the next step, and we can take it to the next slide. Just for giggles and proof in the pudding, I went over to the stock selection guide, the online tools in better investing, went to the search for a company. You can see the criteria I entered for pretty healthy sales growth, pretty healthy earnings growth. I limited it to the utility sector and company that would pay a dividend. They're looking for solid trends as well in pre-tax profit and return on equity. That returned a total of 2 companies, and Algonquin was one of those 2. So I liked that consistency, and I decided to push forward with Algonquin for a couple of reasons. One here is the sales growth and the current PE being a little bit lower. And for those of you that are Schwab folks, Credit Suisse issues a report every morning that you can read, and Algonquin has been mentioned in that, which is probably where I've originally picked up on the name, but now I see it appearing in my findings and my searches. So I'm going to let you look at the slide here. Picture's worth 1,000 words, and I'm going to explain a little bit about what they do. So they're a power and utility company. They own and operate a portfolio of regulated and non-regulated generation, distribution, and transmission utility assets here in Canada, United States, Chile, and Bermuda, which I like that. You can see on the map kind of how they're distributed. So perhaps the folks in the Midwest may be more familiar with Algonquin. Here in Pittsburgh, we're in one of those white areas. That's not a company that I'm familiar with personally. They also generate and sell electrical energy through regulated and also non-regulated renewable and clean energy power generation facilities. So, you know, green, right? Green is cool. That's the thing to be. So having a power company that's focusing on green is something that directionally I like. They own and operate a hydroelectric, wind, solar, and thermal. So I always have an interest in thermal energy production. I think that's something that's old but fascinating as well. They do 2.1 gigawatts, not to be outdone by Back to the Future. They also, through their regulated business, they are in the electric, natural gas, water distribution, and wastewater collection. So I think they have a pretty good mix of business. So regulated means, you know, they're serving the public. They have contracts with municipalities, et cetera. And then non-regulated, they're free to invest and try to take the business into the future. So you can see they have quite a bit of connections throughout their environment. Let's go ahead and move along. They are based in Canada, and they started in 1988. They were incorporated. Hang on just a second. I'm getting a phone call, and I apologize. Okay, here we are at SSG. So taking a look at the visual analysis on the SSG, you can see that the trends are pretty healthy. To quote my Ken, as we all do, the chant, up, straight, and parallel. We can see that we're up, and we're relatively parallel. I don't know about how straight people like things to be, but this isn't too bad. So I like that. The sales projection into the future is, by the analysts, is about 36%, according to here. The item that makes me and everybody think, and is why I wanted to talk about it, is the long-term earnings estimate, as there really isn't one moving forwards. We can see historically the growth of sales is about 12%. And I plugged in a number here that we'll talk about on earnings per share growth of 4%. So let's go ahead to the next slide. Evaluating management, I like to try to marry both worlds here. So looking at the stock selection guide, we see the trends are in the upper section, that table, for those that are not familiar. The trends are all green, which is good. And they are moving in the correct direction, which we like. One of the management perspectives, particularly utility, would be how they're managing their debt, and the company seems to be doing that well. Try taking a whack at evaluating management through the manifest site, which I like to try to simplify the view. So what are we looking at here? We see that the quality of the company has been increasing on the blue quality line, and then also that the projected annual return percentage is moving up and is in the correct direction as well. So far so good. Let's continue on. I've highlighted things here that would be disconcerting, perhaps. So the first thing, the first red square or rectangle, at 12.5% sales growth, I like that number, and in fact that's why I used 12% growth on the SSG, which is much lower than what the 2-year analyst estimates were. The number that would make all of us scratch our heads is the 5-year forecasted earnings per share of $1.17. That's actually going to reflect as a negative growth if you plugged in that number. And that's why one of the things I wanted to talk about here as we move ahead. So overall, you can see, how this company measures up. Overall, no gigantic red flags. Kind of fits in the middle of everything, so to speak. I know that the par is a little bit higher than the sweet spot, but I like to try to push the envelope just a bit. So let's go ahead and next slide. So talking about earnings, what I wanted to show here, for those that are familiar with what would be called the preferred procedure in the stock selection guide, you can see that if you selected on the right-hand side the earnings per share growth section, it will show you what the growth rates are over the last periods of time. So we can see that, for example, over the last 9 years to present, earnings per share has grown at a rate of 24.9 or 25%. The takeaway here is I see all of those numbers both well above zero, not negative, and they're fairly significant numbers. Now, I agree that the last year, the 2019 to 2020 number was lower. It was only 32% growth, but it's still a pretty healthy growth number. So what I did for the most conservative, if I was going to push ahead with analyzing this stock, I took the most conservative earnings number that I could, and I put in 4% earnings per share growth for this company moving forwards over the next 5 years. And you can see that, there we go. Cool. You can see that, and you can also see that I wanted you to think about that. You have a license here to use your own judgment. We use the analyst estimates to kind of back us up and validate our judgments, but sometimes we may want to make a decision on our own. Okay, we can move on. Moving forwards, we always try to estimate where the price might be in the future. So what are the numbers here? I took a look at the average PE, high PE, which is 23.1. Understanding that the current PE is 11.6. And I do believe that, expanding PEs is one way that we can see the value of a stock increase. With the earnings per share number being at $1.67, which is a result of my low 4% estimated growth in earnings per share, we show that the high price could be, over the next 5 years, $38.50. And you can see at the time I took this shot, the stock price was at $15.89. Okay, let's go ahead. So next is the low price, and this is where everybody can really manipulate the stock selection guide in their favor. But I tried to take a very simple approach and not do a lot of fidgeting around of numbers. I have been generally assuming in all of my studies that the year 2020 was about the worst year that I've seen in recent history as far as stock prices go. Of course, I visually validate that by looking at stock price charts, etc. But in this case, it is true. So the year 2020, $9.50 was the low price it experienced, and that's the price I selected for my low price on the recent market low. So now we have a range of $9.50 up to $38. So let's go ahead to the next slide. The one thing I wanted to make sure everybody pays attention to is the dividend payout. So as you're doing your stock selection guide, towards the bottom, I believe it's either the bottom of section 4 or the top of section 5, I forget which one. You have the ability to evaluate, again, the dividend payout ratios. What you'll notice is that there was a lot of dividend payouts or a high amount of dividend payouts occurring up until the recent 2019 and 2020. So two things. One is we know that when we're investing in dividend companies, we want to pay attention to the payout ratios. What I'm taking away from this is my own personal takeaway, is that the company is well managed, and that good management has taken control of their payout ratios and gotten those under control. So I am adjusting down my payout ratios moving forwards from the average of 96% down to 44%. What that will do is that will decrease the dividend yield moving into the future. But that's just a ratio that gets decreased. The actual dollar amount of the dividend will continue. And in fact, at their last earnings call, which was this week, they increased their dividend payment again, which has been something that they've been doing for the last several years. Okay, next slide. So I am not going to present whether it's a buy, hold, or sell. I'm just going to tell you that, hey, you need to think for yourselves on all of these. I know over the years I've presented some really crazy companies, but the stock selection guide is just that. It's a guide. And as my friend Ken says, there are no SSG police out there. So go ahead and think freely, experiment. We're not chiseling anything in granite with this program. So go ahead and, use numbers that you can validate and rationalize yourself. And that's my pick for this time, is Algonquin Power.
Thank you so much, Pat. Mark, take it away with iRobot.
Okay, I'll just kind of step through this fairly quickly. It's a little more conventional analysis compared to the one that I'll do later. And I just basically went out and said, show me some good companies that are likely to be in the buy zone, that represent high quality, that might be beat up price-wise, that are currently not way out of disfavor with the analyst community. And you can see from top to bottom, Ken's going to do in-house. There's a number of companies on here that have been featured at roundtables lately. You can see Charlene's Malibu Boats, so we're fishing in the same waters. Go ahead, Ken. Next slide. Okay, this is kind of cool. For those of you that aren't familiar with iRobot, they make robots, but they basically make vacuum cleaners. 90% of their business is in these vacuum cleaners that wander around your house. Some people set them at night. Pretty cool things, well engineered by iRobot, and it was featured as one of the best gifts for 2020. And a lot of people with the pandemic picked them up to keep their house cleaner because they were in their house more often. So one of the companies out there that benefited from the pandemic. Go ahead, next slide. You can take a look here. You can see that they are distributed geographically worldwide, with about half of their business, 50 to 60%, coming from the Americas, but the rest coming from overseas, with a pretty successful track record business-wise. Next slide, Ken. Here's a look at one of their higher-end machines. And again, I won't go into it in any great detail. They are penetrating markets. I've always wondered, could they get a saturation situation going on? But a lot of people are picking these up. A lot of my friends have these. We have actually thought about it. And again, they've got a decent market share now, but they are looking to take away even more market from companies like Electrolux, etc. Next slide. Here's a look at the stock price over the last 10 years on a monthly basis, and just wanted to make the point that they are one of the companies that got caught up in the meme stuff that went on with GameStop and the short squeeze type environment. And you can see that they went from a stock price of approximately 30 to almost 200 within the last year. And they have settled back down into fairly normal price ranges. Next slide, Ken. Here's a look at the business model for the company. Again, just to get the feel for the up, straight, and parallel, you can see that the sales are extremely consistent. Their profitability is good. Appears to be a very well managed company. A little bit of price fluctuation. Some of that had to do with that GameStop situation. But I think you can see, looking at the profitability on the lower left, pretty steady, consistent progress. PE ratios are maturing and heading for that 20 to 25 range. But we are looking at a company in low double digits for their projected return. Fairly high quality and fairly beat up in price recently. Next slide, please. Here's a look at their upside downside ratio just to confirm that they are in the buy zone. You can see that their price, the current price in the 90s, is less than Morningstar's current fair value. And on the lower right, you can see that, yes, going back over a 6-month time frame, they are beat up compared to where they've been, even though those operating results have been pretty steady and consistent over the last several years. So pretty good indications. And they're leveraged in, and they have high customer faithfulness, commitment, and pretty good consumer position. Go ahead, Ken. Next slide. All right, I fired these guys. I was going to bring Auto Home. That's another one of our best small companies for the next year, but we can skip the slide. I dismissed them. You can dismiss that one too. On to you, Ken.
Well, I'm going to draw up the rear here with my pick of Alphabet. I'm starting with a Chronicle from Manifest Investing, and I like to start with a Chronicle on my SSGs almost all the time. I like to check the quality line. That's that blue line on top, and this quality has stayed between 90 and 100 for a 4-year period of time. I like to see where the current par is relative to where it's been in the past. I put a big red dot where the current par was as of yesterday, and that makes it look like it's just about at a 4-year high if you kind of run your eye across the graph there. There's a couple of other times that it's had a par this high, but not too often. I'm pulling the manifest par value out of 18.1, quality of 98, current stock price of about $2,230. The only difference I can see between the two tickers, and you can actually see it trading under two tickers, Google and Google, is voting rights. I'm not going to buy nearly enough of these shares to worry much about voting rights, so I'm going to buy whichever of the shares happens to be least expensive at the moment when I make the purchase. I find that the two different classes of stocks track very closely to each other. Notice that in the internet content and info category, among the manifest investing stock universe, Goog, the GOOG ranks first, and GOOGL ranks third. Facebook kind of wedges in between the two of them. There's not much difference between those three stocks in any of the metrics that I see. In fact, Morningstar is writing its report, and when you call up Google's report, you'll see that the analysis is actually about Google and Facebook together. That's something that I've never seen before, but that's the way that Morningstar is handling it. When I look at the whole technology sector, I see that the one Google stock is coming in second in the whole sector. I would assume that the other one is coming in 6th or 7th down there. There's Mark's iRobot, by the way, sitting in the 5th position in all of technology. I'm not going to put a bunch of fancy slides out there to show you what Google does. I would just urge you to read the thumbnail. Google does so many different things that it's hard to keep track of them. What I do want you to continue to remind yourself, however, as you think about Google, is that there's two brand names that they deal with constantly that a lot of times we don't associate with Google. One of them is YouTube. Yes, Google owns YouTube, the most widely watched streaming application in the world. And the other word that Google also controls is Android. The Android system is a product of the Google research people, and it controls a majority of the phones on the earth right now. not the other free phone, but Android does. They have a lot of things that they call moonshots. Some of the moonshots are secret. Some of them are small little companies that they're trying to push ahead. You might have heard of Waymo or Google Fiber or Verily. But the bottom line is that Google is a huge company that it's most of its revenue from the search engine, from the online ads that attach themselves to the Google search engine. I used, here's the graph, the anomaly in earnings in 2017 was repatriation during the tax bill that occurred at that particular time. Other than that, this is textbook up straight and parallel. The most recent quarter just blew everybody away. It was an extremely successful quarter. Look at how much off trend the earnings are. Even the sales are a little bit off trend, and that's hard for a company this size to do. I'm calling out the bottom of the SSG. I'm using growth, sales growth of 15, earnings growth of 20. Really good margins, return on equity good and solid, and real low debt. They don't borrow a lot of money, and they have a lot of cash on hand. The chart at the bottom left is from Value Line. There's a revenues and an earnings call 3 to 5 years in the future. The bottom right is from the SSG Plus itself. There's a 2-year sales call and a 5-year earnings call. I think between those two sets of numbers and some other values that I pulled from Zacks and from Yahoo, I'm reasonably comfortable with my two sales and earnings forecast values. Here we are in section 3. I'm using 32 as the forward-looking high PE and 20 as the forward-looking low PE. I think those are both reasonable judgments considering the fact that I have some odd PEs in there from 2017 and that repatriation money that was going on. Choosing lower numbers, I'm comfortable with that because of those odd values in 2017. When the computer finishes all of the arithmetic and this company does not pay a dividend, I end up with a good solid buy, a 5-to-1 upside downside, compound annual return somewhere around 17 to 22%. My 17% in my analysis compares to the manifest investing par of 18.1% in the Y-charts analysis. And as far as I'm concerned, the numbers are extremely close, providing validation for what I'm doing on this SSG. I just tried to find something out of the ordinary. I tried real hard to find a company that nobody had heard of before, hoping to win the contest and make all kinds of money. But I couldn't get past the fact that this great, fast-growing company is sitting here at an opportune moment for us to maybe make an investment. You know, if you have a 20% earnings growth rate and you're giving it a PE less than 30, that's a pretty darn small PEG ratio for you to consider. And this company has it all. It has the graph, it has the data, it has the history, it has everything that we would like to have in a high quality growth company, and it's giving a par practically unheard of from a company the size of this particular behemoth. That's my pick for the session. Folks, as usual, well, I have a couple more slides. Hardly ever do I pick a company where it's not only a 1 in safety, but it's a 1 in timeliness from Value Line, and on top of that, having an A++ financial strength. This is the cream that floats on top of the coffee right there. Here's the 2 paragraphs from the Value Line report. My goodness, those are positive comments coming from the Value Line analyst. Here's the Morningstar. It's a wide moat company, undervalued by about $650. That gives it a 4-star ranking. Remember that Morningstar's stars relate to how much under or overvalued it is. The analysis is a wonderful report. If you're interested in Google, go get the Morningstar report and read it. It is easy reading, and it will make you fall in love with this company if I haven't already done that. Let's move through this lightning round, folks, and we're really stomping on our audience's time. So let's try to keep ourselves to a minute or 90 seconds at the most, please. Cy, your lightning round choice, ASML.
All right, thank you, Ken, and keep the stopwatch going. Keeping in line with the semiconductor theme that I started with, I've picked another supplier to semiconductor companies, and to really keep it short, ASML was founded in the Netherlands in 1984, was supported by Philips Lighting, and eventually became a totally independent company, and they've been a while. But as the company might say, in a nanometer, and for those of you who don't know, that's measurements on semiconductors. In a nanometer, ASML gives the world's leading chip makers the power to mass produce powers on silicon. Their recent shareholders report and guidance increased the company's guidance to 30% revenue growth in the current year. They are a big innovator in essentially allowing chip makers to do the very detailed laser writing on chips that make smaller chips possible. Looks like an interesting prospect.
Thank you, Cy. Hugh has had to leave us. His job beckoned, but Hugh has chosen Vertex Pharmaceutical. I'm going to give you 8 seconds on Vertex. It's sitting, as most of Hugh's choices do, near a 52-week low in trading right now. The sales growth for the last 5 or 6 years has been absolutely steady and remarkable. They've had a little bit of up and down problems turning sales into actual earnings, but they've discovered CRISPR technology, and they're using it to their advantage. If you don't know what CRISPR, C-R-S-P-R technology is, then Google it and come up with what it is and what it does. They appear to be making great progress in using CRISPR technology in doing gene editing to help folks with sickle cell anemia. So it's not a safe, high quality growth stock. It's a typical Hugh McManus choice, but you know Hugh has made wads of money choosing companies like this occasionally. I also think this is Mark's sofa in the basement stock. Am I right, Mark?
It is. We first bought it back around $2 many years ago.
Okay.
We sold it too.
Vertex Pharmaceutical, VRTX. Charlene, Skechers, tell us about it. You have to unmute, Charlene.
Okay, Skechers is a shoe company. It's a medium-sized company. If you look at the sales trend, they've had a great historical upward trend with sales. However, the pandemic has really been rough for footwear, and the sales tumbled about 12% last year as COVID forced stores to close. but you can see the analyst projections expect them to continue to go up. Earnings have been on a similar incline, except for that negative impact from COVID and that 2017 tax hit that was typical to a lot of companies because of the Tax Cut and Jobs Act. The worst is now clearly over. Skechers reported a blowout first quarter report in April, with sales soaring 15% and earnings per share nearly doubling. Skechers expects the momentum to continue for the rest of the year. The company is calling for revenue growth of 27% and a near tripling of earnings per share compared to 2020. Return on equity is in the 15% range, which is, I think, really pretty good, except for that 2017 tax hit and the impact of COVID. They have a rock solid balance sheet even after weathering a difficult year. The cash gives the company plenty of firepower to invest in growth and to potentially buy back stock. The next page, Ken. Oops.
I didn't have another
Oh,
slide.
you didn't have another page. That's
Nope.
fine. Just finish up saying that this company is an 83 quality with manifest. The par is low right now, but I think that par number comes from the impact of that tax break, that tax benefit and or hit, and the COVID effect. However, shares are trading right now around $49. That's just below their all-time high of $53. The buy price I have in my calculations would be to buy it $45 or under. I do own this stock. I also own several of their shoes. That's it.
I own several of their shoes as well. Thank you, Charlene.
Welcome.
Ardelyx. Let's go with Kim and Ardelyx. Go, Kim.
Yeah, guys, many of you know about Ardelyx. The first Aero shows where I wrote up on the Manifest Forum about a man who is on the board of Ardelyx, David Mott. He is from New Enterprise Associates, where he ran a billion-dollar hedge fund in biotechnology. I thought it was very interesting. He had bought $2 million worth of shares it reaches out to a cost average of $6.33 by the end of December. Next Aero shows where their Canadian partner, Knight Therapeutics, announced that it's been approved by the Canadian Health area for the drug for manufacture. And then the other thing, it was decided on April the 15th that it is going to be covered by most private insurances for their reimbursement. In March, they had a new person come onto the board, and believe it or not, she's from Merck. So now that David Mott, who sold a company to AstraZeneca, and you've got a board member who has worked at Merck and did strategic planning. You now have two board members where this stock could end up being bought out by either one of those. That's a possibility. Mid-April, you had the Japanese partner announce 3 more trials. And the end of April, you announced where the FDA said they need more understanding of the mechanism of action of the drug. I'm a retired nurse. This would be called evidence-based practice, that the tenopor works to help reduce excess phosphorus in the blood for those kidneys patients, because they'll be much more compliant by taking 3 pills a day instead of 20. Last but not least, in there I checked when the stock price dropped on the 29th, and then the stock price really went down to like $6.25, and that is going to be a floor, because that cost average for David Mott is $6.33. I happen to also know that the insiders gave themselves more shares at $6.35. Well, isn't that convenient that it's right around the price? And the most interesting thing of all is I went to the SEC website and I looked up David Mott as an insider. Those are the only shares he has personally bought with his own money and not be given them because he's a board member in the last 2 years. So yes, I still think Ardelyx would be a good play, and the stock price is still about $14 a year by 2 different sources that I've found. Thank you.
Thanks a lot, Kim. There's the sales for Ardelyx. We don't have any earnings for this company at this point. Matt, SoFi, tell us about SoFi.
Sure, Ken. So SoFi stands for social finance, something along the line of Kim's review of Palantir. This is actually a company that is not yet public, is going public by a SPAC transaction to be effective June 1st. It started in 2011. Typical tech company started in a dorm room. Social finance was social because it was going to be peer-to-peer student loan financing. That blossomed into, I'll say, plain old student loan refinancing, as well as actually mortgage lending. So unlike a lot of SPACs, which are rightly criticized for being very early, and in fact, one SPAC is a competitor of a company I own, just came out with, I'll say, results, because it's not earnings yesterday. They have a $1.6 billion market cap. They had $300,000 in revenue in the first quarter, but they will have hundreds of millions or billions of dollars in revenue by 2025. You can see by the inset chart here, SoFi had 621 million in revenue in 2020 and will be just shy of $1 billion this year. So they're a real company. They have two good real business lines. What they've been doing since 2018 is funding, rounding out full banking capabilities. And that's the reason why they're going public, is to fund that. They brought in Anthony Noto as the CEO in 2018. They had a number of operational and I'll say cultural issues. Anthony was from Goldman Sachs and was also the CFO of Twitter beforehand. Let me go next slide just real quick. Just to go over the three lines of business. You can see the lending business, what they started with, but still looking to grow revenue at 25%, still in its own right, a small high growth company with nearly 60% margin. Galileo is very interesting. Galileo is sort of, and they describe it this way, sort of like Amazon Web Services or AWS for fintech companies. So Galileo is the platform that the SoFi apps run on, but it also is the platform that other companies like Robinhood and Chime and a very interesting company from Europe called Revolut run on too. So that allows them not only to control their destiny with development, but it also allows them to participate in the success of other fintech companies. And then you have the financial services business growing ridiculously because it starts small, but their idea is twofold. That there will be just a few winners in fintech, and there are a number of companies, Chime is actually one of them as well, who started with one financial service and are looking to round out to sort of capture and cross-sell all their services to their customers. They also were initially looking to fund a bank, but they're actually purchasing a small bank so they can become their own bank, and rather than borrow money for their lending at higher rates or repackaging them, they can actually retain those and get that cheap source of capital from savings accounts. Again, they're going public on June 1st. If you buy shares now, you're buying above the IPO price. That's one convenient thing about a SPAC is the IPO price is always $10. It's a nominal amount. Price today is about $15. So you are buying above the IPO price, but it certainly is far below its high price. And again, this is all highly speculative because they have yet to run. But just to note that the vote is being held by holders as of April 28th. So you will not be able to participate in the IPO vote if you buy shares now. That's SoFi.
Thanks a lot, Matt. Pat, Ollie's Bargain Outlet.
Do that short and sweet. My manifest stock search, I see that this stock is in the lower part of its 52-week range. And I see that the trends are up straight and parallel. Ollie's Bargain Outlet is a growing discount store, so who doesn't like discounts? If you check out the Manifest website, you will note that in the discount stores category, it's the highest par with the best quality. And then also, that's it. It's growing and it's on sale.
Certainly is a textbook set of graphs here, isn't it, Pat?
Yes.
Yep. Mark, Emergent Bio Solutions. Here you go.
Okay, you can file this away in the Mark as being stubborn category. Not exactly up straight and parallel. We'll talk a little bit more about that in a minute, but this is a company that has been established for a while and has been doing steady business. They happen to be the company that's at the heart of the vaccine problem with Johnson & Johnson, with a dirty factory out in near Baltimore, Maryland. And I put them in this list because, first of all, they're one of our best small companies for this year, and they are our worst performer. And I actually keep, much like Hugh McManus, a collection of companies which I regard to be sullied or loathed. Call it the sullied and loathed index if you want. These guys are in a lot of trouble, and they basically have some challenges. But the point that I want to make is that this stuff passes with time. We are a forgiving nation. And couple points I want to make. First of all, this is just one of their manufacturing locations. That is not a COVID map down on the lower right. That just happens to be a map, but they do have 9 manufacturing facilities, and they make a lot of stuff for other people other than Johnson & Johnson, and they are a leading supplier to the government for things like anthrax and this Narcan, which is for opiate situations, and they do provide travel vaccines for the government. Now, the thing with the vaccine problem that they have right now, which I think is going to be a passing storm, no one knows. I'm not comparing it directly to the Tylenol thing, which happened back in the early 1980s. Some of you probably remember that. But remember that Johnson & Johnson basically destroyed the entire existing inventory of Tylenol in a move that is now heralded as high integrity. Not quite the same thing. People were actually being murdered back by the Tylenol situation. In the case at Emergent Biosystems, it was basically one bad batch, which they caught and took care of. You can see the statement made there by the Robert Kramer last week at the conference call for their earnings conference call. They haven't lost any customers yet. So again, keep in mind that there are more manufacturing locations. They're fixing the situation at this particular plant, et cetera, et cetera. They only received a warning letter. They didn't even receive a warning letter. They received this notice called an F483 notice from the FDA, which is not the end of the world. It's not the end of the world. They haven't actually received an action letter known as a warning letter, and they are taking steps to address the situation. Next slide, Ken. So here's a look. It's one of our best companies for best small companies for the year. So that's what the red rabbit's for. Again, it's kind of like stuff going through the Python. They take on large contracts. They have a huge $600 or $700 million contract, which they will find a way to complete with the government on this situation. But again, all of the businesses lines are intact. I think that the storm is going to pass. And call me stubborn. Looks like a pretty good picture to me.
Okay, thank you, Stubborn. We appreciate it.
Oh, but there's the circled wagons.
Okay.
I asked Ken about the situation last night, and I said, well, it's about EBS. He said, who's EBS? And, it's one of our 20 companies for the year, Ken. It's like one of our children. I said, what worse sign that they're neglected than us forgetting about one of our children? Go ahead.
And finally, at 1 minute to 5, I get to tell you my lightning round selection. It's Enghouse Systems. Folks, this is a Canadian company. So if you want to buy it, please use the American ticker. Use the American Exchange ticker, which is at the top of this page, EGHSF. If you use the Canadian ticker, which also exists in the Better Investing database, you're going to be charged a trading fee even if your broker doesn't normally have trading fees. So if you want to buy this one, use the American Exchange ticker. very difficult to find information on this company. There is a CFRA report, and it's relatively positive. CFRA has buys on this company and has very good data available for you to take a look at. This company sets up networks. It's in 2 divisions. The biggest division deals with setting up networks of all different kinds for all different types of industries. It might come to your town and set up an emergency network for 911, and then it might go to another town and set up a network where you can speak to your doctor in your hospital system. Very, very different kinds of things. There's a great explanation of what they do as a business on their website, a really, really good investor presentation, but finding information from the analyst community on this Canadian company is difficult. I like the graph. I like what CFRA had to say. I like the idea that I can do an SSG and come up with reasonable values, and those give me reasonable return values. So I'll put it on a list of stocks that might have a great return over the next 6 to 12 months. Enghouse Systems, a company out of Toronto, Canada. That is the end of the session. We did not expect it to go this long, and we apologize to those of you that are still with us. We're glad to see so many of you choose to stay around the entire time. This slide is at the end of the pack. If you want to get the entire deck of slides, all you have to do is write a note to Mark R. at manifestinvesting.com, and he'll send the entire pack of slides out to you. I don't think there's any errors on this slide. I've proofread it 3 or 4 times. So with that, I wish you better investing. I hope we've given you some really great ideas, and I hope some of the ideas that we've given you today turn into profit for you by the time 1 year is over. Folks, if you're in the audience, why don't you say goodbye to everybody?
Goodbye, everybody. Thanks for tuning in.
Bye, everyone. Have a good weekend.
Goodbye,
Have a good weekend.
everybody.
And enjoy watching Emergence Biosolutions go from worst to first. It's our worst.
You're disqualified, Mark, because you used slides in the lightning round.
Okay, now we're just in a mob again. So I'm going to shut us down and say good night to everybody. Goodbye.
Good night. Great
Bye.
conference.
Thanks, everybody.